How does equity work in a house? What is equity? Does my equity increase by the amount of my payment each month? Stay tuned to hear the answers to these sometimes confusing questions and learn more about what it means to have equity in your home. Let's pretend that you buy a $100,000 home and have a $100,000 loan. So you owe the bank $100,000. The amount you owe is called the principal balance. As of right now, the predicted yearly appreciation for next year on a home is 3 to 5%. That means that if it's worth $100,000 today, it should be worth $103,000 to $105,000 in a year. So you now have $3,000 to $5,000 equity in your home based on the appreciation, but you still owe the bank $100,000. If you put $20,000 down on the $100,000 home, you would have the $20,000 plus the $3,000 to $5,000 in equity, meaning you only owe the bank $80,000. Well, what about my payments, Pam? I'm paying the bank $1,000 a month. So won't I have paid off $12,000 of that $100,000 loan in a year? Well, not so fast. $699 of that payment is the principal and interest, and the other $300 goes to the taxes and insurance. So then I would have the $699 times 12 months paid off, right? Also a no. The bank charges interest on your loan, and that interest is high at the beginning because you have a high balance. The current rate is 7.5%. So when the bank calculates the previous 30 days of interest and is charging you $699 a month, you owe $625 in interest, and only $74 goes to the principal. The next month, you pay interest on $99,926. That's the principal. So the interest is $624.54, with about $75 going to the principal. At the end of the year, you have only paid off $1,000 in your principal balance. So in a year of $12,000 in payments, you will have only reduced your equity by $1,000. As you pay the loan down, there is less to pay interest on. Therefore, less of your payment goes to interest and more of your payment goes to the principal balance, or what you still owe the bank. Now, there are many ways to help you gain equity faster. One of the best ways is to pay the equivalent of one extra payment a year towards the principal balance. So that would be like paying $1,000 more a year on this loan. If you do this every year, you can pay off the entire mortgage 5 or more years sooner. On a $100,000 mortgage, in 10 years, you would still owe almost $87,000. But if you pay $1,000 a year, you would only owe closer to $71,000, therefore continuing to pay less interest on your balance. On average, a homeowner stays in a home for 13 years. If you don't make any extra payments, the amount of equity from your original loan will be about $20,000. And if the home increases 3% a year, it will be worth about $147,000. Therefore, you have gained $47,000 of appreciation over 13 years. So the $47,000 plus the $20,000 paid on your loan equals $67,000 you have in equity. If you pay that extra payment every year for those 13 years, you would have $89,000 in equity. Hopefully this gives a bit more clarity into equity. A simple way to put it is that it is the amount you will receive when you sell your home after paying off all the loans due on your home. And don't forget, when you go to sell, you will pay your favorite realtor out of those equity funds.